Good morning, everyone. Good afternoon, everyone. Welcome to session 8 of MOOC 13, Cryptocurrency and Central Banks. Sorry for the short delay today. We had to change a little bit the infrastructure, and let me give you a little bit of a broader update not relating to the MOOC. So, as in many parts of the world, we had our first cases of coronavirus on Monday in Cyprus. And I think actually in a fairly responsible manner, within a day, the ministry suggested that the universities go to remote teaching across the board. And so over the last couple of days, we have been reorganizing the university so that for while or until the government feels they have a handle on how many cases there are and what the spread is of coronavirus in Cyprus, we will be teaching everything online. Now, you as participants in an existing online course, an online program, are completely unaffected. So we are continuing with our absolutely normal class schedule and normal delivery methods. But you will see, I am not in the office today. I am at home, and we're doing casual Thursdays. And we've been very busy today because we're moving about 1,000 class sections that typically would be offered on campus to prepare to offer them online from Monday. And so you'll excuse me, I was both a little bit late, and I've been a little bit distracted today. I am not in the office today. Now, so I am at home, and we're doing casual Thursdays. And we've been very busy today because we're moving about 1,000 class sections that typically would be offered on campus to prepare to offer them online from Monday. And so you'll excuse me, I was both a little bit late, and I've been a little bit distracted today. I am not in the office today. I am at home, and we're doing casual Thursdays. And we've been very busy today because we're moving about 1,000 class sections that typically would be offered on campus to prepare to offer them online from Monday. And so you'll excuse me, I was both a little bit. So that is just good general life. And I've been a little bit distracted today. I am not in the office today, so I am at home, and we're doing casual Thursdays. Completely independent of anything the university is doing. I think have I cleared the feedback loop now? Are we okay? I think it was actually not my local speaker. I had the phone line open to. I had the phone line open to Dimitris. I was talking to him on the cell phone, and I think that's where the feedback loop was coming from. So I think we're clear now on the feedback loop. If not, please let me know in chat. Okay, super. Well, let's get going. We have some questions. Some of them are actually difficult questions with no actual answers. But we will give it a shot. I'll give you some initial thoughts, and then maybe we chat on the interactive piece in the chat and see if we can come to some conclusions or even maybe raise some questions. So the first one is, as more and more central banks are taking a keen interest in cryptocurrencies, there are no consistencies in dealing with this between central banks. Would it become difficult for cryptocurrencies to work universally and efficiently and become unruly due to the different rules imposed by different central banks? cryptocurrencies will impact the payment and settlement system which central banks currently oversee. So I think this is a good question, and I think this is a question that we'll cover even further on the regulatory session. The issue of different countries having different rules, or in some cases no rules at all, or in some cases blanket bans on cryptocurrency, is absolutely a real issue. It's in fact worse, in quotes, than what is noted in this question, because some regulatory matters have to do with central banks, but cryptocurrency attracts a variety of regulators, sometimes securities regulators, sometimes money transmitter regulators, sometimes central banks, sometimes tax authorities, sometimes commodity regulators. So because it's like many things, but also like nothing exactly that exists, you have a situation where many regulatory agencies take an interest in it. So for sure you have different rules across countries. You sometimes have different rules within countries from different regulatory agencies. And this, I think, is going to take a while to harmonize, but I believe it will harmonize. So right now, the best example of this is the European Union, which is a good example for these types of topics. Today, there's a variety of national level legislations. Bit by bit, though, you see the European Commission is working towards, I believe, a common policy framework on cryptocurrencies. It's happening in bits and pieces. So the fifth AML, Anti-Money Laundering Directive, now includes what they call virtual currencies, which picks up cryptocurrencies, and is now something that needs to be implemented by all the member states. For a broader umbrella regulatory framework, no, the EU is not there yet, but I suspect in a few years it will be. So right now you have a patchwork of national legislations or no legislations at all that are broadly in similar directions within the EU, but have some differences. I think in time they'll be supplemented by broader EU legislation. I think in time you'll see some harmonization between the EU and the United States. There might be other areas where it takes longer and there might be less harmonization. For example, one very dramatic example recently was in India, where the Central Bank of India had, in effect, banned cryptocurrency. And then the Supreme Court of India overturned the ruling a few days ago, and now the central bank is appealing. So here we still haven't even gotten to the point where there are consistent and stable approaches within countries, let alone across countries. So for certain usage cases, I think it is a hindrance. I think it is something that will slow down adoption. For other usage cases, less so. And I expect kind of sensible time frame to believe this settles down to reasonable stability where you'll know what you can do where and what things are common and what things are different. Might be 5 to 7 years. It's one of the main differences that I find with cryptocurrency relating to the internet in general, because the internet in general is just information, and particularly in the United States where it was first popularized, the US has very strong free speech protections under the First Amendment. The internet was able to develop with a quite light regulatory touch. With cryptocurrency, where there's money involved and where a lot of various authorities, including central banks, are taking the position that it is a topic that should be regulated, regulation will be more of a challenge, topic, hindrance, thing that needs to be dealt with than it was with pure information-based protocols. And so we are seeing this play out in practice. It is going to be a real thing. But I do believe over time, the types of countries that have similar types of economies and similar types of regulatory regimes for their financial system will coalesce around broadly similar types of regulation, legislation, policy approach, and what have you. So when I say similar, what's a interesting similar point that has to do with, in fact, the central bank? Some countries have openly convertible currencies and some countries don't, right? So an openly convertible currency, you can exchange it for other currencies at a floating exchange rate at whatever the market rate is from time to time, without any limits. A country with that type of existing currency system, currency zone, can more easily handle a cryptocurrency like Bitcoin. Because it doesn't challenge the existing regime as much. If, on the other hand, you have a country that has a fixed exchange rate, capital controls to enforce it, you can't freely take the currency, the national currency, in and out of the country, it makes public cryptocurrencies more problematic, because even though that's not necessarily their intention or what they were designed for, they become a very easy way to circumvent capital controls, because you could be in the country, convert your sovereign currency for cryptocurrency, send the cryptocurrency out of the country. It's not hard for cryptocurrency to cross borders. And suddenly you've circumvented the capital controls. And so there, you should expect, and similar to what we've seen, that those types of countries have been stricter in how they deal with cryptocurrencies, because if they're not, it's like locking the front door of your house and leaving the back door open. And the reason they're acting this way is not because they hate cryptocurrencies or don't like cryptocurrencies or think anything specific to cryptocurrencies. It's because I think they would act that way to anything that circumvents their capital controls, because otherwise their capital controls will be ineffective. So there's not going to be one clean answer around the world. There's no longer a clean answer around the world on the internet. You have this balkanization even today of the internet, where certain countries do very heavy filtering of internet domestically and externally. China has the quote-unquote Great Firewall, right, that allows certain external services to work in China and certain external services not to work in China. Certain services that are allowed to work in China, whether they're domestic or international, have certain restrictions that are different than what the restrictions are in different countries. And you say, oh, okay, well, that's just China. Well, no, it's even true in Western countries where there's differences in laws on free speech. So, as I mentioned earlier, the U.S. has among the most liberal protections or broadest protections for free speech. So, more or less, you can get on the internet and say whatever you want, whether it's super intelligent or super stupid or offensive or what have you, right? It is not illegal in the United States to be a jerk, to be an idiot, to say dumb things. You have to get pretty far off the spectrum before it becomes illegal. A classic different example is Germany, for understandable historical reasons, has stronger bans on Nazi-oriented speech. And so you might take the same service, Twitter, and a certain tweet that might be allowable legally. I'm leaving aside the internal company policy. The internal company policy might be whatever it is. But I'm going to the national level policy. It might be allowed legally to happen in the United States, in that exact same tweet might not be allowed to happen in Germany. And what you see with these global internet services like Twitter, they have been, even though, and I use Twitter as an example because it's an interesting case study. When Twitter, a few years ago, Twitter's policy on tweets was that it was the free speech wing of the free speech party, that Twitter was not going to get involved in policing people's tweets, and people can say whatever they want, plus or minus. For better or for worse, and not judging it sociologically, which is the more correct approach, that is no longer the case. Twitter censors tweets by country based on the national legislation of the country. So there could be a tweet that is censored in Germany but not censored in the United States. There could be a tweet that's censored in Turkey that's not censored in Germany, and vice versa. And even in the United States, Twitter, from a internal policy perspective that's not required by the Constitution of the United States, but for sure has to do with broader political pressures facing Twitter, has been more aggressive about limiting certain types of speech. So if you use the internet as an analogy here, and you say, well, with the internet we had the idea that we're going to have the same thing everywhere, and national borders don't really matter, we're going to be in cyberspace, and the rules of cyberspace can't bound us. Well, it's not really true anymore. Even if it was probably never actually true, but it was, at least there was a time one could believe that. I don't think that's the case anymore. I think the case is that national borders do matter, even for internet-based services. But it doesn't mean that the internet didn't matter. Information dissemination is still vastly, vastly broader and better with the internet than it was pre-internet. So if you take a country that is, has the internet, but censors some search terms, censors some content, and compare it to that same country 40 years ago, when maybe it had 20 newspapers and 5 television stations and 10 radio stations. That country 40 years ago was in a much, much stronger position to censor and control the information flow, because you had a handful of centralized points of information, and they might follow certain party lines, so to speak. With the internet, it's true. There is progressively more filtering, censorship, whatever you want to call it, of content, but there's still vastly more information available than there was in the old world, and vastly more difficult to censor billions of people on millions of websites than it was to censor 5 TV announcers on 5 TV stations. So I believe this is where we'll end up here as well. It will be more regulated than text, words, images on the internet. It will be regulated. It will be regulated inconsistently across the world at large. It will be regulated more consistently within economies with similar parameters. And it will still be a significant step forward for digitization, decentralization, and innovation than before cryptocurrency existed. So that's my kind of summary view on that question. I'll answer it one other way as well. Imagine that question wasn't speaking about cryptocurrencies per se, but CBDCs, central bank digital currencies. There, I believe there will be more coordination among countries, because if you imagine a world where the major currency zones each have a CBDC. Well, the major currency zones are highly concentrated, right? Like the dollar is the world's reserve currency, and then you have the euro and the British pound and the Swiss franc, and the one is, because it's not convertible, it's not a reserve currency, but it's a large money supply. It's much easier for those institutions to collaborate with each other than with thousands of public cryptocurrencies to collaborate with each other, and also with central banks. So I would expect, my expectation is we will have CBDCs. My expectation is ultimately the major, then the minor currency zones will have CBDCs. And then when they do have CBDCs, I believe they will come to an agreement on what the interaction model is between one CBDC and another CBDC. Because there, it's a much simpler conversation. If the Federal Reserve agrees with the European Central Bank on how the digital dollar will interact with the digital euro, it's still not going to be easy. Regulatory and IT harmonization is always difficult, but it's one entity speaking to one other entity. It's highly plausible that they can figure it out. Okay. Next question. SWIFTs versus CBDCs. This is great. This is why I love this course. There's not that many people in the world that are having this discussion right now, and on the 12th of March 2020. So here's the question. In the extra Q&A segment posted for this week, Andreas Antonis says there isn't much difference between SWIFT and the new CBDCs. However, isn't SWIFT merely a messaging system for payment orders, such that the real movement of funds have to be implemented through movement of funds primarily via correspondent banking? In-banking systems not really a part of SWIFT. Also, SWIFT handles movement of commercial bank deposits, which is a lower form of money in the hierarchy of money than central bank money. If CBDCs are placed higher in the hierarchy of money, wouldn't that be a difference from SWIFT? What a really great question. I agree with the parameters of the question. I believe, and I haven't read the Q&A, but like knowing Andreas very, very well, what I believe Andreas means when he says CBDCs and SWIFT are not very different, I believe he means that they are both centralized permissioned systems. So from that angle, and this is obviously a hugely important point about public cryptocurrencies in general, and for Andreas Antonopoulos specifically, that he considers what is important and innovative about Bitcoin and other public cryptocurrencies is that they are decentralized, is that they are permissionless, is that no central authority can say, I am blocking Bitcoin transfers to this address of Antonis Polemitis because we think he's a bad guy for some reason. From that perspective, I think Andreas is right that CBDCs and SWIFT will be similar. So SWIFT is permissioned. It is absolutely subject to AML related and legal orders. And I will be very surprised if CBDCs aren't designed in the same way. Now, you could imagine CBDCs being designed in a way where that's not the case. You could imagine someone issuing, a central bank issuing a digital dollar or a digital euro on a public blockchain like Bitcoin, a Bitcoin-like blockchain, not on Bitcoin itself, and then backing up the value of it and keeping the value parameters where they need to be by buying and selling unlimited amounts for, a dollar being a dollar. And otherwise letting it be permissionless and allowing it to transfer freely in exactly the same way as cash, right? Cash is a permissionless system. I can go give you 20 euros. and there's no central place, there's no central database that someone can flip a switch and prevent me from giving you 20 euros in cash. All my discussions with central bank staff since 2014 suggest, even though they might understand or think conceptually that that might be an interesting idea, they believe that politically it will be very difficult to do. That politically, if there's a CBDC, it will end up being a permission system. It will end up having baked in KYC and AML type requirements, because politically it would be very difficult for a bank to come out and say, yeah, I'm going to have my digital banking central bank currencies, and I'm going to let people just do whatever they want with them, and even if they are terrorists, drug dealers, and whatever the whoever is typically used in these examples. I'll say it a different way. I believe it would be politically impossible in 2020, if cash didn't exist, for central banks to invent and issue cash now. I truly think this is impossible. Cash is there because it has historically been there, and because it is somewhat difficult to get rid of it, even though we I think there are some central banks that are trying to get rid of it. They might not come and say it openly, but they're trying to get rid of it. So that's my sense. Now, there's another difference that's, not exactly a question, but it's a statement in that statement, which is correct, which is, well, SWIFT is not a money transferring system. It's a messaging system. Someone else has to transfer the money. And that's right. It's a common messaging system. Public cryptocurrencies and CBDCs that are blockchain based are in fact likely to be different in that the message is the transfer. So there's no difference, there's no possibility to say, here is a transfer, and separately the Bitcoin's moving, right? The instruction to move the Bitcoin is in fact, as processed, the movement of the Bitcoin. So I think this is correct from that perspective, that there is this type of conceptual difference between SWIFT and a CBDC or a public cryptocurrency. The third question embedded in here. SWIFT handles the movements of commercial bank deposits, which is a lower form of money in the hierarchy of money than central bank money. What are CBDCs going to be? Are they going to be central bank money? Are they going to be commercial bank deposits? Would that be a difference? Yes, it might be. It depends what CBDCs are going to be. In a direct model, I think they're central bank money. In an indirect model, they might be commercial bank money. And so it's super interesting to think through that. I don't think there is a clear answer to that yet. And I don't think we're going to know for a while what the solution to that is going to be. I'm going to post something. I don't know if, oh, no, I can't post it. Can someone answer in the chat, does the course material include this very interesting flower of money graphic that the BIS put out in 2017? I'm waiting for someone to answer in chat. Okay, well, we need to. All right, Dimitris has answered. We need to get this to the students. I think it's a great graphic, and it tries to combine four dimensions: things that are central bank issued, things that are peer to peer issued, things that are widely accessible, and things that are digital. And I believe it's the best example that I've seen to lay out these different topics. And they have CBDCs and cryptocurrencies in four buckets. So they have central bank digital currencies, wholesale, which they are saying are digital, central bank issued, and peer to peer. Central bank digital currencies retail, which they're saying are digital, central bank issued, peer to peer, and widely accessible. And then permissioned DLT cryptocurrency, which they're saying is peer to peer, not widely accessible, digital, not central bank issued. And permissionless, that is not central bank issued, peer to peer, widely accessible, and digital. So I think the exact parameters of how CBDCs are issued are going to matter a lot to these discussions. And we don't know yet. And I suspect we will see this question get resolved in practice as people go ahead and issue CBDCs. So Dimitri, if you can post in Moodle the what do we call this, money flower, I think it's a nice graphic to touch upon these issues. Okay. Next question. It is often claimed that monetary policy only influences short-term rates in the money market. Is this so? Why or why not? This is a major issue. There's no directly correct answer. I think the very safest answer I can say is it influences short-term rates much more, because it obviously is a short-term rate itself. Now, clearly, if the short-term rate drops, it is almost certainly the case that it should drop the long-term rate as well. However, the long-term rate takes into account a variety of other factors that don't have to do with the short-term rate. So let me try and give you a sense of how to maybe think about this. Let's take the maximum short-term rate, which is the overnight lending rate. If we know the overnight lending rate, then we know that tonight, between now and tomorrow, the interest rate is going to be X. There's very high certainty what that's going to be, because there's not many things that might happen between now and then, right? So if you go to the central bank and it says, all right, well, or even a commercial bank or the money markets or whatever, say, we're lending overnight at 0.5% annualized, your level of confidence that that's how much you're going to lend at is extremely high. The long-term rate is going to change over time, right? It's going to have, there's other subsequent events. So you're taking into account still broader monetary expectations, inflation expectations, expectations of what the banks might do, the central bank might do later. And so my sense is there is the directional impact, and I just saw the questions right before the material, but I bet there is research on this. I think it is quite correlated. So I think it does influence it, but I think as you go into longer durations, the precision of the influence starts weakening because other factors come into account. But it's a good question. It's an excellent question. about the kind of limits of how you can impact monetary policy. Okay, another related question. In the course material, it is said that a central bank has a role as lender of last resort. Isn't the role of dealer of last resort at least as important? I'm thinking of dealing in securities and of foreign exchange. No, I think not, actually. And I'll tell you why I think that. The lender of last resort is, I believe, the absolute key to what keeps the commercial/retail banking system functioning. And the commercial/retail banking system is literally the circulatory system of the economy. It is the functioning, it is what allows the real economy to function. Every single individual, well, that's not necessarily true, but like almost every individual with any significant amount of money has a bank account. Pretty much all businesses have bank accounts and loans and deposits and what have you. And the whole economy is driven through the banks. Historically, in ye olden times, before deposit insurance, before modern investment banks, bank runs were fairly common, and you would have kind of collapse of banking systems and kind of random damage that this entails. And then we had a very long period in kind of developed economies where this topic was put to bed, more or less. And it was put to bed through a combination of deposit insurance, lender of last resort, resolution authorities, and you could operate your personal or corporate financial and economic life assuming that your checking account, your savings account, your payments were there as functional payment mechanisms, and you were not taking in any way investment risk. And so I think the way people in practice thought about their financial affairs, if they bought a stock, if they bought a bond, if they bought precious metals, commodities, oil, etc., they understood that the price might go up, the price might go down, they might have investment gains, they might have investment losses, it might even go to zero. If you said, I have a checking account at Chase or HSBC or Bank of Cyprus, and my customers are paying me, and I'm paying my employees and my vendors, and my employees are getting their payroll check in their bank account, and then they're paying their mortgage and their car payments and their groceries. Nobody in practice thought they were making an investment, that they had decided in practice to lend to the Bank of Cyprus. I'll use as an example because it's relevant. They've made a credit risk assessment of the Bank of Cyprus, decided the Bank of Cyprus is at this level of credit risk, and decided therefore to have their checking and savings account earning 1 or 3% or whatever it's earning there because they thought it was a great investment opportunity. It was utility banking. And I think that's right. That's how people should think. There is absolutely nothing to be gained by requiring every single person who needs payment and storage, let's call it functionality, which is at a first approximation, everyone, to have to turn them into bank analysts, right? Like analyzing bank balance sheets is a very difficult and sophisticated finance art. And even then, a lot of people get it wrong. A lot of very sophisticated people with CFA qualifications and gone to fancy business schools and worked in investment banks still get it wrong. There's absolutely no societally important reason why Mary, nurse, Bob, barber, Jim, university professor, Sally, small businesswoman, Mike, large businessman, should have to know anything about the financial statements and balance sheet of a bank. And it's a complete waste of everyone's time. Well, when did we see an almost breakdown and then an actual breakdown? We saw an almost breakdown in 2008 in the United States, where as the financial system started locking up for the first and only time in my life in the United States, it crossed my mind for some businesses I'm involved in that the checking accounts were well over the $100,000 deposit limit. And does this mean, is the money at JP Morgan Chase sitting in the checking account that effectively, intuitively, you consider to be risk-free, is it going to be there in the morning? And then what should you do? Should you start distributing to multiple banks? Should you open accounts at 10 banks? And where does the FDIC, Federal Deposit Insurance Corporation limit apply? Does it apply here? Does it apply there? It's a very complicated question. The US ultimately backstopped the complete financial system. And in the case of retail and commercial banking, that was correct. They absolutely did the right thing by letting businesses operate their way normally through the financial crisis without also have to worry that their banking relationship's going to blow up on them. In Cyprus, we had the unfortunate experience in 2013 to be the case study for what I consider one of the stupidest episodes of modern central banking. There is a variety of historic, effectively political background on why the Eurogroup and the Republic of Cyprus got into this position. Broadly speaking, because the Republic of Cyprus annoyed them, but that still doesn't, I think, justify the decision and the approach. Well, the decision and the approach, the famous Cypriot haircut, banking haircut, bail-in haircut, was the following. The ECB concluded that the Cypriot banks were insolvent, that they had fewer assets than their liabilities, and decided to stop lending to them. And then said, well, you have to come into balance, and the way you're going to come into balance, because you don't have a lot of debt on your balance sheet, you're going to go haircut the depositors for a form of debtor. And the conclusion was in Bank of Cyprus, which was the largest bank in the country, 50% of deposits above 100,000 vanished overnight. And in Popular Bank, which was the second bank in Cyprus, 100% of deposits vanished overnight. And when we say over 100,000, we don't just mean for consumers, right? We mean for hotels and accounting firms and restaurants and investment funds and pension funds and people's savings. This was an end-to-end disaster for the Cypriot economy and end-to-end stupid policy, because it took a problem that existed at the banks. Fair enough, there is this problem. We believe at this point assets are lower than liabilities. So hold that thought. We agree that there is this problem. And resolve the problem by literally randomly throwing hand grenades into the Cypriot economy, destroying businesses and people and people's lives and perfectly functional businesses, only because they had the bad luck that on a certain day in March 2013, they held a lot of money in their operating accounts at these two banks. This is an absolutely terrible policy choice. The economic effects, and then, of course, the social and human health and whatever effects, were within 8 months, I think unemployment in Cyprus went from 3% to 25%. And only now, about 7 years later, and this is with Cyprus being a quote-unquote good performer, are things close to back to normal. It might be 5 or 6% unemployment now. But this is policy stupid. there is no rationale to say, here you have 10 businesses in a sector, and these 5 were just going to end up blowing them up today for no particular good reason other than they had a lot of money in the bank. You'd have scenarios where a hotel would get 20 million of cash pre-bookings from Thomas Cook for the summer, and if they had gotten the money on the 11th of March, it vanished the next day, and they're bankrupt. And if they had gotten the money a week later, they were fine. Again, this is not a way to efficiently manage the economy for the maximum good of producing real products and services for people. So, what could you have done, given you have a lender of last resort? Well, I think you could have done what the U.S. did. The U.S. certainly had some banks that, under similar treatment, might have collapsed. I believe the U.S. did 2 things. They continued to lend to the bank. They continued to be the lender of last resort. They allowed the banks, in effect, to steepen their interest rate margin between what they charge people for mortgages and credit cards and what have you, and paid people less money on deposits and what have you, and earned their way out of it. And eventually, the system came back to life, and you did not randomly throw a neutron bomb into the economy. So I'm not saying that keeping orderly securities markets isn't important. It is. I'm not saying that keeping orderly foreign exchange markets isn't important. It is. But at the end of the day, the wealth of any particular society is determined by how many real goods and services they create. How many real goods and services they create has to do with how big the population is, what percentage of them are working, how advanced is their productivity based on their skills and the tools, machinery, software that they use. This is how you create real wealth, which is why, I believe correctly, a lot of central banks have within their remit not necessarily keeping the currency 100% stable. They're not saying the currency is an investment instrument. It's a policy tool to manage the economy, and one of the objectives could be keeping close to full employment. Because once you push a country, as Cyprus was pushed through the haircuts, as Greece was pushed through the very hard money policies in their bailout, when you push it to having 25% unemployment, well, you're destroying real wealth, not financial wealth. Because if some of the ways I try and think about, does this policy make sense, is imagine not a country, but imagine a village. Imagine you had 100 people in a village. And imagine you concluded, based on deposits, liabilities, blah, 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 that there was no money to pay 25% of the village to work. And now 25% of the village is just sitting around while the other 75 works. Would you ever conclude that? Would you ever conclude that the best way to manage the wealth of that village is to keep 25% of people on the sidelines doing nothing? I think the answer is clearly, obviously, strictly speaking, no. And so when central bank outcomes end up leaving countries it raises huge questions about what commercial banks are here for, what's going to happen to the economics of commercial banks, how you handle lending, and so on. And so it's a very difficult question. It's a very difficult topic, which is why the system so far is continuing as is. So anyway, I think we are out of time, and I think we actually covered all